Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. Now, seeing how this is our final episode of the year, I figured that we end things with something super relevant to this time of the year, and that is how to perform a year-end trading review. Now, before I forget, this is going to be another video episode, so if you want the full experience, and what I mean by that is seeing me in a salmon sweater, make sure you head over to Spotify where they have both the audio and the video versions of the podcast, or head over to the YouTube channel as that's where I share all the video versions as well. With that being said, no matter how you choose to view, make sure you do me a favor. 1, leave a rating and a review for the show. And 2, make sure you follow on whatever your favorite podcasting app is, or subscribe to the YouTube channel. That way you don't miss the awesome content that we have coming your way in 2026. So before we get into the specifics of what we're looking at in a year-end review, let's talk about why it is important to do a year-end review. And it's important because we have to remember that trading is a business, or we should treat our trading like a business. And this is something that's been ingrained in my head by both of my mentors for a very, very long time. In fact, something that really stood out to me early on in my trading career, where I may or may not have been treating my trading like a business or understand the relevance of doing so. One of my mentors told me this: Akil, the difference between a hobby and a business is this. Hobbies cost you money, businesses make you money. Which do you want your trading to be? And of course I said, well, yeah, I want to make money out of my trading, duh. And he said, well, then you need to start treating your trading like a business and start making money instead of doing all the dumb things that you were doing. And that was a big game changer for me. So if you want to be a consistently profitable trader, well, you have to treat your trading like a business. And when you hear Jason and myself say this publicly, we typically are referring to the normal stuff. So we're talking about having structure in your trading, not literal structure, but structure as far as things like having a fully developed trading plan, having a rules-based trading approach, having a clear risk management and money management tactic, having a clear idea of your daily routines, your personal payouts, stuff like that. But there's another huge part of trading that we need to pay attention to as well, and it doesn't get talked about enough, and that is doing these type of consistent reviews, and especially the annual review at the end of your trading year. So in most businesses, there is someone or someones who audit your performance, right? It could be an accountant, it can be a manager, it can be someone on the board, it could be an outside source that you bring in so they can do so with a non-biased kind of approach, right? No matter what it is, someone is checking up on your performance and someone is helping you optimize what you are doing, or tell you ways to optimize what you should be doing in the future. In trading, however, and this is the gift and the curse of being an entrepreneur, there is no one to do that for you aside from yourself. Well, I guess there you could bring in outside people to do it, but in most cases as a trader, this is your responsibility to do it yourself. And if you're someone out there who is asking yourself, well, Akil, what's the purpose? Why do I need to do it? Well, let me ask you this question. If you don't audit your performance, if you don't do a review, how do you know if your business is thriving or quietly dying? You don't, and there'll be a lot of emotions that are sucked up in there making you think whatever it is that you want to think. So a review is important, and I'll start by sharing with you what my review process is. So personally, I like to do what I call mini reviews throughout the year, right? I do these every quarter, so every 3 months. And I look at these mini reviews as being very similar to like maintenance checks, right? So if you're taking your car in just to kind of make sure the performance is running okay, or if you're going to the doctor just to make sure your body is running perfectly fine, right? These are routine checks just to make sure everything is going well and or identify anything that may pop up that I need to keep an eye on. Now, during these maintenance checks, right, I'm not trying to overhaul anything. I'm just looking for any red flags. So let's say one of these red flags pop up, and a red flag would be something that is kind of out of the norm. Maybe it's an elongated period of drawdown, or maybe a win rate isn't what it's supposed to be, or maybe just something isn't working the way that I think it should be working. Again, I don't make a big change, but I give it a check mark. I write it down in my little journal, and I make sure that it's something that I keep an eye on for the next review 3 months down the road. So let's say that, I'm trying to think of an example right now. Let's say that a specific entry tactic isn't performing the way that I think it's going to perform. Well, I don't want to change it right away because a 3-month period isn't long enough to kind of make any type of impactful decision, right? We can go for 3-month drawdowns. We can have 3-month heaters, right? 3 months in general isn't enough time to kind of get a true tell of what's going on. But I do think 6 months will give you a pretty good clue. So I will pay attention to that entry tactic. I will say, hey, these first 3 months, it didn't perform that great. So let's kind of keep an eye on it to see how it performs over the next 3 months. And in most cases, things turn around and it reverts to the mean and it starts working the way it's supposed to work. And it's unchecked and erased in the journal and I go back to business as usual. But if for some reason the same trend that I noticed in the first 3 months continues in the second 3 months, well, now I'm aware that something might need to change. And during this period, because I'm keeping eyes on it, I've already started thinking about solutions to that problem. The point is, I am extremely patient with when I make adjustments to my trading. And this is something I think traders need to do more of. And think about it like this, right? One of the biggest things that gets traders into trouble is system hopping, right? It's hopping from one system to another system. Pretty much that happens when you trade something and you have this expectation that it doesn't work right away, right? The whole chase of instant gratification. And then you say, oh, it stinks, it stopped working. And then you go to the next shiny thing. And the next shiny thing works for a little bit and then it stops working and then you hop to the next shiny thing. And the problem with that is, right, when you leave something the moment it stops working only to jump to the next thing and that works for a little bit and then eventually stops working, what usually happens is that the original thing that you thought wasn't working but you bailed on starts working, but you never get to see or reap the benefits of it working because you already bailed, right? It's this weird cycle of doom that traders get into, but it's strictly due to instant gratification. We want instant results, and when we don't get instant results, we don't have the patience to kind of tread water or wait through the storm to see the quality results, right? This is why backtesting is so important, right? I truly believe that you can't or you shouldn't live trade until you've backtested because you don't have that belief, you don't have the bigger picture. In your bigger picture of backtesting, what you see is you see the ebbs and flows. You see the good periods of your trading strategy. You see the meh periods of your trading strategy. You see the bad periods of your trading strategy. But then, assuming it's a successful strategy, you see yourself go from the bad periods back to the good periods. And that allows you to understand that, hey, I am going to go through these different cycles and I just need to wait them through. And bigger picture, right? Law of large numbers. My strategy indeed has the edge. It also gives you an idea of how long those periods last for, where it's like, hey, I know that my system can take 5 trades in a row routinely, or 5 losing trades in a row, let's say, routinely, and then it gets back to its winning ways. And therefore, in real life, when you get those 5 losing trades in a row, you're no longer up in the panic and bailing and hopping to the next strategy. You're like, this is normal, this is supposed to happen, I'll take 5, then it'll rebound and yada, 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 and you're more likely to stay with it. So I bring this up because 3 months, right, I would never make a trading decision of whether I'm going to trade a strategy or not after 3 months of backtesting, right? It could be the best 3 months in the world, it could be the worst 3 months in the world, just isn't enough data. Therefore, why would I want to make a significant change in my approach after 3 months of said red flag, right? If I've backtested 15 years and over those 15 years, it has told me that, hey, as I accumulate all this data, my strategy has an edge. Why the hell would I bail on 15 years of data plus whatever live trading data I have because of a little 3-month blip, right? Doesn't make much sense, but that's where the emotional side takes over and we panic and we do dumb things because we are human beings. So I am not in a rush to make any changes. 3 months of observation, another 3 months of observation. If it still exists after 6 months, that's the soonest that I can make a change. I've done that a few times, but typically I don't make any changes until I see the entirety of the year. And that's precisely why this year-end review is so important. It allows me to see the big picture and be in a position to make proper judgment. And that comes from really digging into the numbers. So speaking of numbers, let's go to the most important number that you need to dig into. And that is going to be, drum roll, P&L, right? I know you probably expected something fancy, but let's be honest, right? Why are we trading? To make profit, right? So therefore, if we are not making profit in the market, should we be trading, right? No. So we want to make sure that we are doing or getting the result that we desire. Now, we're going to talk about the process and all that stuff in a little bit, but end of the day, right, we have to produce. If you're not producing at your job, you get fired. If you're not producing in trading, you're losing money and you should probably do something else. So let's make sure we are producing. And the way we look at that is by looking at our P&L, as well as another metric that is more important than our P&L. So understanding our P&L is important, right? We need to know, did we make money, did we lose money, or did we break even? And yes, it is completely normal to look at the dollar figure when doing this. But the metric that is far more important than simply the dollar figure is going to be the ROI, or the return on investment percentage, because that's what's going to tell you the real story, not just for now, but in the future as well. So here's an example. I was actually having the same conversation with a good friend of mine the other day, where we were both trying to explain to people the difference between percentage and dollars and how you should value one versus the other. But let's give you guys an example, right? Let's say you ended the year with $1,000 in profit. Would you be happy? Well, some of you would probably say yes. Some of you would probably say no, right? We all value $1,000 differently. I value $1,000 differently today than me 20 years ago, right? Because we're all at different parts of our life. We're all in different places in the world, yada, 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 yada. But let me add another layer to this onion, whatever it is, right? If you made $1,000 of profit in trading off of a $25,000 trading account, would you be happy? Well, some of you newer traders would be like, well, yeah, Akil, because I didn't go broke and I've been losing money for the last couple of years. Okay, I understand it, right? As a newer trader, just break even. But let's say you're an established trader, right? The answer is probably no, right? Making $1,000 off of a $25,000 account is a 4% return. Now, although I am a big fan of making something is better than making nothing, the honest truth is 4% probably isn't worth your time, energy, and effort in the market. Now, let me ask you this. If you made $1,000 off of a $2,000 account, then would you be happy? Well, probably. That's a 50% return, right? Which is a whole different conversation. So you can see the actual profit figure stayed the same. It was $1,000 no matter if you were a trader A or a trader B, but the return on investment was significantly different based on the account size that you're trading. That's one of the reasons when you see these gurus out here talking about, I made this much money and that much money, it doesn't really mean anything, right? Because, okay, well, if you made $5,000 off of a $1 million account, you're not that good of a trader. If you made $5,000 off of a $5,000 account, you're an incredible trader, right? So you got to take that stuff with a grain of salt, and you got to look at how much drawdown went into making that as well, but that's a different layer that we don't want to touch. The point is, your return on investment, your ROI percentage, is going to be the most important metric, because this will also tell you, or give you an idea at least, about what your future performance could be. So time and time again on this channel and on the podcast, you've heard us talk about process over outcome, process over outcome, process over outcome. And this is another way of thinking big picture, right? Take the right actions, you will get the right results. So I want you to think about process over outcome in this kind of monetary perspective, right? Because it just doesn't apply to individual trades. It applies to our money management and risk management tactics as well. We'll take the example of trader 2 who made the $1,000 off the $2,000 account, which is a booming 50% return. I don't expect you to make a 50% return in the market, but if you do, Good job. You are considered a good trader. Now, let's say that this trader can repeat this 50% return on a consistent basis every year. And theoretically, it should be true, right? It should not matter how much is in your trading account. If you are taking the right actions, right, you should be able to produce the same outcome. Well, year one doesn't really seem like much. I turned $2,000 into $3,000. Whoop-de-doo. But if you can consistently replicate that process for 5 straight years, right, without taking any money out, so reinvesting your profits back into your trading account, well, all of a sudden that $2,000 in just 5 years turns into a little over $15,000, right? You do it for another 5 years, and this is going to be crazy, right? That $2,000 now is worth over $115,000. So just by simply creating a 50% return on investment, in 5 years, you went from 2,000 to 15 plus. In 10 years, you went from 2,000 to 115 plus. That's freaking nuts. That is also called the power of compounding, and I would encourage that you go to any type of online calculator and start inputting your numbers, meaning your current trading account and your expected return on investment, and see how long it will take to get you to the place you want to be. It's also why return on investment matters much more than dollars. Now, I got a secret for you. Come a little closer, right? That is just by reinvesting your trading profits. If you want to accelerate that, 2 things you can do. 1, you can implement a money management strategy. Tier 1 traders, you guys know we use the smooth ratio money management strategy. That allows you to kind of increase and accelerate those profits. 2, you can get a handle on your personal finances, meaning, clean up your budget and start saving more, maybe even get an extra job. And while you're making these trading profits and reinvesting that back into your trading account, you can also take side money and reinvest that into your trading account. And now you're just accelerating your wealth even quicker, right? Those are the real secrets. It's not really doing anything different on the charts. You don't need to kind of risk more, become more aggressive, or shoot for bigger targets, right? Typically, when traders do that stuff, it ends in the opposite result. They go broke because it's doing dumb stuff. Rather, just do the same thing that you've been doing, the thing that is making you money, and then scale it, right? Scale it by those different tactics that I told you. All right, you can back up now. So now that you know about return on investment and you know how important return on investment is, the next question that commonly comes up, and I know you're thinking about it because I've been exactly where you're at right now, is, well, how do I properly judge that? How do I know what type of ROI is good and what type of ROI is bad? You told me 4% wasn't worth my time. You told me that 50% was good. There's a big range in between there. What is good and what is bad, Akil? Well, I have 2 solutions for you, right? One is going to be looking at what I think your performance floor should be, so like your absolute bare minimums. And then another one should be your realistic expectation, which is going to be individually based. So first and foremost, understand this, right? Because I know a lot of newer traders listen to this podcast. When you first start trading live, you are going to be at your absolute worst. And I don't mean that as any type of shame, but when you start anything for the first time, you're usually bad at it. And then as you work through it and you get reps and you get practice and you gain experience, you tend to get better at it. So I mentioned this earlier, and my mentors told me this, right? In your first year of live trading, the goal should be simple, right? Just don't go broke, right? Don't go broke. That's one goal. A second goal, I know it sounds bad, but it's 100% true, right? Don't go broke is one goal. A second goal is be break even. A third goal is to make any type of profit, just survive. If you can do that, you are doing better than most. I know. I'm probably crushing some of your dreams right now, especially if you're coming from a social media feed that is filled with traders who are bathing in money in their long flowing hair, right? Going in the wind as they're driving in their Lambo. But the honest truth is, right, that 90% of traders lose 90% of their money in the first 90 days of trading. That's a common saying in this industry, but it's also very true in speaking to brokers who actually have the statistics of traders coming in and blowing money during that specific time period. So although making a little bit of money or being break even or even just being a little bit below the zero line may not seem like an accomplishment, if you consider that 90% of traders are losing 90% of their money in the first 90 days of trading, if you can be better than that in a full 365 days of trading, in a weird way, that is a win, and you should feel good about yourself. You shouldn't be satisfied. You should want more, but at least you didn't go broke. Motivating words from yours truly, I know. The point is, trading is hard, and you should tap yourself on the back for just surviving. Sometimes, hey, that's the goal. Now, getting back on task, right? So, what is going to be a solid minimum performance floor, right? And my opinion for this is this. That was a bad sentence, but you guys get what I'm saying. You should want to outperform whatever your passive investments are. And this is a rule of thumb that I give to the traders that we work with on the platform when they're doing their back testing, they're asking Akil, what are good results, right? That should be the number one goal as far as results, right? Outperform your passive investment floor. And what I mean by that is stuff like a retirement fund or like an index. So for example, right, your average retirement fund is probably returning about 10% a year, somewhere in that range, right? Yeah, not that much, right? Your average index, let's take the S&P 500, for example, right? That roughly averages like 11% a year, believe it or not. So honestly, you should try to beat that. Now, the S&P does have bigger years. Don't get me wrong. There are years where it's in the 20s, right? And maybe even in the 30s, but there are also years when it's in the negative. So when we're talking about average returns, we're talking about the historical average. So if you're outperforming both those things, let's say just 15%, because that's above both of those numbers, then yes, you can consider that a win. And the reason I say outperform that is because, again, trading is cool, and some of us are really trading nerds. Like I like to think that I would still be interested in the markets even if I wasn't consistently profitable, just because I love the puzzle. But like I mentioned earlier, at the end of the day, we have to make money, and we are investing a lot of time, energy, and effort into this thing that allows us to make money. So if your performance isn't outperforming your passive investments, and by passive investments, I mean the things that you spend 0 time or maybe 1% time, energy, and effort on, is there a point of trading, right? It would be very similar. It reminds me of this conversation. My mentor, Jason Stapleton, had this podcast called The Jason Stapleton Show a long time ago. And I can't remember when this was, but he was interviewing, I think we were going through like a job situation, unemployment situation here in the US. And he was interviewing a woman who was on, having brain farts, on unemployment, right? So for you guys that are overseas, I'm not sure if you have the same thing, but when you are on unemployment, it pretty much like it means you either can't get a job or you're unable to work, and for a certain amount of weeks, right, the government gives you money, right? That way you can survive. And we're going through this whole unemployment thing, and he was interviewing this lady, and he's like, well, let me ask you this. She's like, you're on unemployment, right? She's like, yes. He's like, well, are you capable? Are you actively looking for a job? And although you're supposed to say you are, most people aren't. She's like, no. And he's like, well, why not? Don't you want a job? And she's like, well, let me ask you this. I'm getting paid the same amount to sit at home and do nothing as I would if I were out there working, 40 hours a week. Would you do that? And he was like, good point. So bringing it back to trading, because I don't want to start a whole debate on that. Why would we work our behind off to produce the same thing that we can produce by not working our behind off? It doesn't make sense. So if we can't beat those benchmark numbers, there really is no point of trading. And again, this is consistently, if you're new, it's going to take you time to get past those numbers. But if you're someone who is historically producing that, you may want to rethink your trading future, to be honest with you. Now, as far as your real benchmark goes, right, I said this is going to be individual because every person and strategy and risk appetite is different. But you should be looking through your back testing results if you are new, meaning the numbers and the performance that your back testing numbers showed you, or your historical trading range, your historical performance range if you're someone that's been trading for a while, because that is going to give you the best idea of what your system or strategy should be producing. Now, here's what I like to do, right? So when I was a beginning trader, I used my back testing results, but I've been trading for 20 years now, so I've got a pretty good sample size of my historical range. I like to create a very simple line chart, right? I graph it out because I'm a visual person. And I like to create a line, which is kind of my highest return on investments for the year. I like to create a line that is I hope I'm doing this correctly, that is my lowest, there we go, return on investment for the year. And then, if I can get enough fingers here, I like to create a line which is my average. And this gives me a very nice range of kind of where I should be. I know that at my best, I am here. At my worst, I am here. On my average, I am here. And I try to play a game of where this year's line falls. Ideally, it should be somewhere above the average. And I mean, I would love if it was above the highs. That would be great. But ideally and realistically, it should be somewhere above the average, but below the highs. And if I can do that, I know that I am in the right place trading-wise. If it's below, then I know there might be trouble. Now, I suppose that for you guys that are doing backtesting data, you can actually do the same thing, right? Because you have tested lots of years in your backtesting, you can easily sort out the best year, the worst year, and the average and play the same game. Now, real quick, just speaking of backtesting, always forget to remind people of this. Understand this, traders, right? Come closer again, right? Your backtesting results are probably going to be better than your live trading results. Now, can you take any guesses of why that may be? You can pause it if you want time to think and you don't want me to spoil it for you. But the answer is because in your backtesting results, you are in a perfect trading environment. Insert like a green screen with rainbows and unicorns and stuff like that. But you have so much time to evaluate your trade and find your trading opportunity. You have so much time to rethink stops and targets. If you miss something, you can go back and look at it, right? It doesn't matter if it's a trade that's 2 o'clock in the morning and you're fast asleep and you don't really have time to adjust targets in real life, but in backtesting you do, right? Everything is perfect. In real trading, change rainbow and unicorns to like hellfire and fury, the markets are harsh. You are going to make emotional mistakes. You are going to miss trades just because you're sleeping or you got called in to pick up a kid because they got sick. You're going to miss trades simply because your eyes didn't see it. You're going to have emotional responses to being in a trade where you're going to enter early because of FOMO. You don't want to miss out. You're going to move stops backwards because you don't trust your stop loss and you're snorting that hopium, right? You're going to exit trades early, like in the podcast episode I gave to you the other day, because you can't deal with the emotional yo-yo of seeing yourself being in this much profit, but needing this much more profit to actually cash out on the trade and turn it into actual profit. You're going to make these mistakes, right? And as I mentioned earlier, as a newer trader, the newer you are, the more mistakes you're going to make. So therefore, although you have these perfect backtesting results, your realistic results should be a little bit lower than them because of human error. Ooh, I'm going to hold this one better. I like it. It's too light. Let me go back to this. Sorry, shiny thing syndrome. For you guys listening, I'm doing these graph things with like random pens and pencils that I'm finding around my chart. By the way, go Toffees. We need some players. Nottingham Forest today. It's going to be tough sledding, but hopefully our Sean Deitch revenge game doesn't go poorly for us. As I get off track, this is a perfect time to do a little bit of a shameless plug, right? If you're interested in learning how to trade, because I don't talk about it nearly enough here, head over to our website, www.tier1trading.com. We work with traders of all levels. We start from the very beginning and go to the very advanced. We've got community, we've got courses, and we've got a lot of live resources. Ooh, that rhymed. That's pretty good for you to check out. www.tier1trading.com. I recommend starting with the 14-day risk-free trial membership. That way you can get your feet wet. You can see what we're about before making any type of financial investment. But there's no time better than now. Start the year with a fresh slate. www.tier1trading.com. All right, let's get back to the show here and let's talk about some secondary metrics. So the lesser important metrics that you should pay attention to but aren't nearly important than asking yourself, did I make profit? So these secondary metrics are going to be stuff like win rate. They're going to be stuff like average risk reward ratio or your overall risk profile, right? The things that matter but only really in context. Now, if you've heard the podcast episode, Who Gives a about your win percentage, Well, you know that there's no such thing as a good win percentage. It's going to vary from trader to trader based on their strategy and based on their personal appetite to take psychological pain while in the markets. So once again, the only comparison that you can make between was my win percentage good enough or bad enough is either your backtesting results and or your historical performance results. So it's a number you can look at, but doesn't really mean all too much. Something that is worth paying attention to is your profit target taking, specifically for you guys that are doing multiple targets, meaning you're splitting your trade into different levels where you're doing a target profit 1 and a target profit 2. And this is something that many traders overlook and a big mistake that I made in my trading career once upon a time. So a lot of traders think that chasing bigger targets are better. And why is that? Well, one, because it makes more money, maybe, but it also feels good. And we do things that make us want to feel good, even if it isn't necessarily rational. The flaw of being a human, one of the flaws, there's many of them that we have. So despite us feeling good and thinking that it's making us more money, we don't want to think. We want to look at the metrics and actually be sure that the thing that is supposed to be producing us more profit is actually producing more profit. Because if it isn't doing so, it's a problem. So when going through your results, don't just look at your P&L, just don't look at your win percentage, but look at your P&L of target 1, look at your P&L of target 2, and if target 2 isn't higher than target 1, you have a problem and you probably shouldn't be taking target 2 because it would be more beneficial to you and your pockets and your trading account and whoever your trading money is going to, kids during the holiday, that you take everything off at target 1. And it's not as fancy, it's not as exciting, but it's more profitable. And my philosophy is this, right? I'm not in trading to be fancy and exciting. I will buy fancy and exciting things with the money that I make from trading. So yeah. Another layer that you want to look at, right, is breaking down the performance, and there's lots of places we can go here, but by pair, by asset, or I guess pair or asset, and by setup, and then a combination of all of them, meaning that look at your individual assets that you're trading. If you're in the Forex market, it's looking at your individual pairs. So the euro dollar performance, the pound dollar performance, the euro yen, whatever you're trading. If you're looking at specific stocks, breaking down the specific stocks, commodities, right? Whatever you're trading, break them down into the individual form and look at that. You can also do the same for strategy. So if you're a trader that is trading multiple strategies, let's say you are trading a harmonic patterns, you can look at BATs versus Gartleys versus ciphers, or trend continuation versus structure versus counter trend, right? Whatever it may be, but break whatever you're doing down into its individual forms and then look at those numbers individually. Because what we're trying to do here is we're pretty much trying to identify our 5-star employees, right? This is a business. We have a big business. Everything we trade, they are employees of ours. And sometimes in business, you have to be harsh. You have to cut your employees. So as you do your performance review, you want to see which of my employees are performing well, that I certainly need to keep, maybe give them a raise, which of my employees are doing okay, we'll keep them around, keep them at the same pay structure, but yeah, they're here, they're doing what they're doing. And then which employees are slacking and may need to have a performance review where they potentially get cut from the portfolio. I'm in two minds. I'm severance mode. I'm in two mindsets between an actual job and then trading results. But we want to do this, and this is how we can potentially strengthen our portfolio, right? There is something called, and I may have to Google search this, I think it was the Pareto principle, and I forgot the actual person's name. I think it starts with a V, but you can look it up. But anyway, the Pareto principle, or the 80-20 principle, says this. It says that 80% of your something efforts come from 20% of your causes. And this can be looked at as a good way and a bad way. We'll start with the good way. So let's say I broke down all of my pairs, right? I trade a 9-pair portfolio, and I broke down all my pairs and looked at them performance-wise and looked at their P&L. And let's say I noticed that the bulk of my P&L came from 3 of these pairs. Well, it may be more beneficial to me as a trader not to waste time, energy, and effort on all 9 of those pairs, but to focus only on those 3 pairs. So I may make the decision to say, hey, I'm going to cut the other 6 pairs and just trade these 3. Now, not to get too confusing, but we also know that you do need different type of employees, right? You can't just have a team of all-stars. You need role players as well. So some of those pairs that maybe didn't perform in the upper whatever percent are still useful because they balance your other pairs out during the drawdown. So maybe you don't cut all of them. But the point is, if you have certain pairs that outperform others, or more specifically, if you have certain strategies that outperform others, you can start treating them different, right? This is what we talk about with like the grade A and grade B trade setup. So let's take the same type of Pareto principle for that. Let's say that, what did I mention earlier? Let's say that I noticed that my trend continuation trading strategy is by far my best trading strategy. Like the bulk of my results, right, bulk of my profits come from this one strategy. And my other strategies, they're cool, right? They're all right. They do their job. They make money. They give me frequency when I'm not getting my trend continuation trades. But the bulk of my money, right, comes from this. Well, as a trader, maybe you make a decision that says, hey, I want to invest more in my trades that produce more. So you can start adjusting your position sizing, where it's like, hey, I trade full size on my trend continuation trades, but I only trade half size on my other trades because they're just not as good, right? So this allows us to properly evaluate that instead of being like, oh man, I think my trend continuation trading did better because I remember this one big trade on the dollar yen where I made 250 pips. But if that was the only great trade of the year and that strategy was crap for the rest of the year, it's not really worth investing more in that strategy. We just have that emotional attachment to it. So when we dive into the numbers, we can actually put our emotions to the side, right? And actually see what is producing and what is not producing, or at least kind of rank them and see where they're at. Now, I'll give you an example on the opposite side of the spectrum. I once had a strategy, right, with a really low win rate, but a really huge average risk and reward, or risk to reward, right? So you're asking yourself, what's the problem, Akil? You got a low win rate, you got a big risk reward, it balances it out. Yes, in back testing, but in real life, just as we spoke about in the previous podcast, those emotional demons were haunting me every time I was in this trade. Now, the bad thing about this strategy as well is it would go on massive losing streaks, which is another emotional trigger that makes you want to take profits early because you're like, man, I just lost 10 trades in a row. Like, I got to get something, right? So anyway, when I was evaluating my performance at the end of the year, I noticed that the bulk of my mistakes, and we'll talk about reviewing mistakes next possibly, the bulk of my trading mistakes, right? So the 80% of my trading mistakes came from this single strategy, the 20% of the strategies that I'm trading. I'm trying to work this principle in there. I know it's not making perfect sense, but stay with me, right? The bulk of my mistakes was coming from this one strategy, right? So therefore, what I was able to say is that, hey, my goal was to eliminate my mistakes. And if this one little thing is causing all of these mistakes, by eliminating this thing, I therefore eliminated this thing. Boom, problem solved, right? 80% of the result was coming from 20% of the cause. So get rid of that 20% cause and I eliminated 80% of that negative result. Boom. So in some cases, we want to do more with the things that are doing better for us. And other times you want to kind of do an addition by subtraction type of thing by eliminating the things that are doing us bad. And we don't know that unless we crunch the number. Something else real quick while I'm speaking about that strategy is something else we want to pay attention to is going to be maximum drawdown. Now, this is going to be a maximum drawdown is pretty much a drawdown is your period of losing. Technically, it is your period between previous equity highs and new equity highs. So you can kind of actually be floating at break even for a little bit, but as long as you haven't created new equity highs, you haven't gotten out of your drawdown. But drawdowns or knowing your drawdown is important mentally, as we spoke about earlier, with understanding losing streaks and having the confidence to not jump ship on your system and see it through. But especially if you are someone who plans on doing something like a prop firm challenge, knowing this is very important. You see, when you do these prop firm challenges, it's not like you're just an independent trader. So me, I can go through any type of drawdown I can want. I have the luxury of being able to lose as much as I want whenever I want to. Ha ha, take that, nanny boo boo, right? So mature of me, right? I promise I'll change in 2026. I won't change at all. I'm going to stay the same. But the point is, I don't have any restrictions because I'm working for myself. The only restrictions that I have are the ones that I put upon myself. However, if you're working for a prop firm, whether it's a brick and mortar prop firm or it's an online prop firm, you're trading someone else's money, right? So you have restrictions. There are certain things you can or can't do. And in many prop firms, all prop firms, your drawdown is one of those things. So they give you a limit, whether it is a daily limit, whether it is a weekly limit, whether it's just a strictly a monetary limit, right? You have a limit of how much you can lose. So what happens is a lot of the traders that we work with over at Tier 1, as they make the jump to prop firms, they find themselves needing to readjust their strategy, right? Because they have a strategy, but now they have to fit that strategy within this new set of rules. Now, fortunately, they are trained to be able to adapt and adjust and make these type of adjustments. That's what happens when you're a well-rounded trader instead of just a system follower. Ha, take that. But if you're someone that is married to a strategy, something that you really, really like, and you want to do a prop firm challenge using that strategy because that's the thing that you're good at, it's important that you know what that maximum drawdown is or what your average drawdown is. That way you can know if you're ready to start this challenge or not. And if you are, then you can plug and play, boom, you're good to go. If not, then at least you have time to go back to the drawing board and say, hey, I have to make these adjustments in order to fit inside this type of category. Let me spend the next year or next whatever months doing that, or just go back and adjust whatever needs to be adjusted before you can go back and take that challenge. So it allows you to save time, but it is an important metric to know. All right, so let's go back to mistakes, right? Return on investment, ROI, tells you about the outcome. Mistakes tell you about the process. Mistakes or lack thereof, but mistakes is what we're digging into. So I've said this 1,000 times, and I'll say it again for those in the back or for those who are new. By the way, if you're new, make sure you follow, subscribe, check out all the cool content we have here. But I highly recommend that you grade your trades. And when you grade your trades, it's not just win-loss, right? A win is in an A+ trade and a loss is in an F, right? Because we know that you can have the best setup in the world and it can lose. You can have the worst setup in the world and it can win. So it has no meaning, to be honest with you. But you need to grade yourself off of the process, right? Was it a good trade or was it a bad trade? A good trade is one where you followed all your rules. A bad trade is one where you didn't follow all your rules. Now, you can make it as black and white as that, where a good trade is a A+ or a bad trade is a F-, or you can actually be very specific and kind of break down what's in your good trade, right? Break it down by routine, analysis, entry, exit, trade management, and grade yourself off of all of those scales. Doesn't matter how you do it, depends on how detailed you want to be, but you need to have an idea of what your trade grades are. And I say this because this is the only way that you can ensure that you're improving in the process, which bigger picture will help you improve your results. So, for example, I've had great years, and sometimes you have great years just because the markets are great to you. You hit on some really, really big trades during the year because of whatever's happening in the market, and the end result makes you look amazing, right? I remember that my best year was about a 60 or 65% year. And the next year I was disappointed because I didn't hit that, right? I'm one of those people where it's like, I believe in the Kaizen philosophy of, 1% improvement, small, deliberate, consistent changes get big results. In fact, if you guys follow me on social media, right now I've been doing a plank challenge, right? So my goal is to get to a 5-minute plank. So plank is like when you hold yourself in a stable position. I'll put a picture up on the screen for you guys. And I want to do it for 5 minutes. I don't know why I want to do it for 5 minutes, but I like challenging myself mentally and physically. So that's what I'm doing. The point is, I'm not hopping in and doing a 5-minute plank on day one. No, I would get some sort of hernia and be out for whatever weeks, right? Rather, my goal is each and every day I've been adding 5 seconds. So I'm on day 8 at the time of recording this, or day 9, I guess it is. And I started with a minute. And right now, or today, I have to do a minute and 40. And part of me wants to do it on camera during this podcast for you. But you guys also don't want to just sit there and watch me like plank and be still and struggle and cry a little bit for a minute and 40 seconds. So just check the social media and you'll see a post above it. The point is, right, I always want to continue to get better. And a long time ago, I would judge that off of the result. So when I came off that 60+% year and I followed it up with only like a 40% year, I started thinking I was a loser. I started thinking I was bad. What did I do different? How come I suck now, right? And the reality is, and I got this from speaking to my mentor, was like, hey, no, I actually did good. I actually had a better year of trading process-wise, right? My average grade was better than my average grade of that 60% year. I just didn't hit those big winners. That year, I just happened to hit a bunch of home runs, right? There's nothing I can do about it. I can't control it, right? This year, I had one home run trade. That's it, one opportunity. So like, you can control only what you can control. But if you continue to improve the process, you give yourself a better opportunity of increasing the floor of your performance, I guess you can say, but also giving yourself more opportunities to make those big years even bigger. So that's what we want to track. It also significantly limits the chance of us going broke, which I'm not sure if I mentioned, is a very important thing and a very scary thing as well. So as you're grading your trades throughout the year, right, you should be jotting down little notes. Journaling, the thing that no one wants to do, but everyone should do. And those notes should be honest notes. And for mistakes specifically, you should be like, hey, I did this, I did that. You ideally want to write what caused that mistake as well. I took targets early because I was afraid of FOMC announcement, right? So that way, when you know the cause, you can kind of fix it. But you want to track your mistakes throughout the year. In your year-end review, what you need to do is you need to go through all of those trades, the entire trade log, right? Lots of scrolling, and you need to start ranking those mistakes, right? So open up a spreadsheet, put them into a category, move stop loss, took targets early, entered early, fell asleep, put wrong order on, whatever it is, and then rank them in order of what you are doing the most to what you are doing the least. After you do that, you'll clearly be able to see which of these mistakes you need to approach and you need to attack first. And start with the biggest one because that's the one that's hurting you the most, and then work your way down to the smallest one. Now, this was the exact method that I took during, I guess what you would call my biggest breakthrough in trading. Because like many of you guys out there, right, there was a time where I was really, really bad. I was losing. And instead of accepting blame on my own, I would blame everyone else. It was the market conditions. It was the president. It was politics. It was Janet Yellen, the Fed chair, whoever was Fed chair back then. It was the broker. It was this. It was that, right? And by looking at these mistakes and more importantly, doing an A-B split test, I was able to see that the one true problem was me. And what I mean by A-B split test was this. So I took my year-end results, and I had them already. And then I went back to all those trades that had mistakes on them, and I looked at what the results would be if I didn't make said mistake. And then I took those results, talking about the P&L or the ROI, and I lined them up against each other. And I saw that, man, my live results were bad, but these perfect results were good. Maybe my live results were bad because I was doing all the bad things that caused them not to be that, right? So these results should have looked like that, but because I was doing bad stuff, they looked like that. Maybe it's me, right? And that was just like the biggest eye-opener for me. So going back to the list of mistakes, what I decided to do at that point, because this is like, I was at a rock bottom period. I was blaming everyone. I decided I was going to quit trading. My nest egg was low, right? So my origin story for you guys that haven't heard Trading Coach Podcast episode 000, the hidden episode, which many of you guys don't know about. I recommend going back and listening to it. Just ignore like the weird intro music from back in that era. It's embarrassing, but the content is good. Anyway, I quit 3 jobs to focus fully on trading, right? So I jumped off a cliff with no parachute, and figured I'd knit something to save my life on the way down. I don't recommend that to anyone, but it worked for me because I need to be motivated by urgency. I need to be put in. I'm an athlete. Right? I need the ball in my hand with 1 second left to be at my best. Right. So I needed that do or die mentality, because if I didn't, I would just make an excuse not to be good. So anyway, I thought I would be successful within a certain amount of time. I saved enough money to survive without an income for a certain amount of time. And that certain amount of time was running out. And I was like, oh crap. Started dusting off the resumes. We got to get back into the workforce, and all the things that I left, I had to return to do. So I was pretty depressed and whatnot, at the darkest of lows, or whatever you want to call it. So I told myself I was going to go for one last hurrah, right? And I said I was just going to do what my mentors and coaches told me to do the entire time. Just trust the process, stick to the plan, all that boring stuff, right? And I did this review, and I noticed that I was making mistakes, and that I probably should have been profitable if I weren't making mistakes. I was good at analysis. I just was bad at the emotional stuff. And I decided that I would make a goal, just for blanks and giggles, that I'm just going to work on making less mistakes each month. And I did that. And the funny part of the story is, right, it was in the spring, I think like April or something like that. And I got a statement from my broker at the end of the month, as I usually do. And at the bottom of the line, there was a number, and it wasn't in parentheses. Parentheses means you lost money. And I emailed my broker like, hey, you sent this to the wrong person, blah, 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 blah. And they sent me one back that says, no, this is you. And I said, what? I made profit? And going back and doing my review, because it was right around kind of a quarter area, I realized that I had significantly cut down my trading mistakes, and that significantly increased my profit. And I was like, oh my gosh, I should have done this years ago. And that was a game changer. I never looked back from then, but I needed that moment of pain turned into profit to really kind of understand how it works. And hopefully by sharing this with you guys, you don't have to go through as much pain to get the picture that you should stop doing the dumb stuff, right? But that was really, really big for me. So identify the problem. Once you identify the problem, you can start coming up with a solution for that problem. Once you come up with a solution for that problem, you can actually start taking action on solving it, and that should solve many of your trading woes. You're welcome. Now, speaking of trading woes, and I don't mean woe as a negative, but like, whoa, this is awesome. I've got a cool gift for you guys. Again, it is a free trading computer builders and buyers guide. So if you're someone like me that knows nothing about computers and you're curious about what needs to be in a trading computer because you're going to build your own, or maybe you're just going to go out and buy one and you want to know what you're buying so that you don't waste money, it's very, very helpful. I've used them twice. I've actually had them build both of my trading computers as well, and I've been very happy with them both times. So check it out. It's 100% free. Just scan the QR code in front or check the link in the description box below. I got one more thing to talk about, right? And this was a question that came from you guys. So I put a thing out on social media saying, hey, I'm doing a year-end review Trading Coach podcast episode. Let me know if there's anything you want to hear about. I covered many of the things that you guys asked about already, but there was one that kind of didn't fall into a category. And this question was about how to use objective observations collected throughout the year. So things like alternative entries, things like structure levels, or things like new indicators. So pretty much going back to the journaling thing, throughout the year, maybe we have ideas that we're thinking about implementing into our trading. Maybe we have observations that we're observing in our trading. What is the process of taking them from the journal to actually putting them in your trading? And I think that's a very, very good question. Now, the key to this comes well before the year-end review. The year-end review is taking everything that we already have and kind of figuring out what we want to do with it. So it's like the groceries are already in the kitchen. We just got to figure out how to cook it. The observations, this is when you're in the supermarket, which is during the year, and what you're buying. I don't know, maybe it makes sense. Anyway, the point is, we should have an idea of what we are observing, what we are tracking, what we are considering implementing well before the year-end review. And what this means is we need to track it consistently throughout the year in a few different ways. So I'll give you a good example, right? So the last change I made in my trading was the implementation of the volume profile tool. There's actually a YouTube video that I did. If you guys want to know about it, what it is, how to put it on your chart, how to use it, check it out. It's a really cool video for you here on YouTube, or on YouTube if you're listening to this on a podcasting app. But the point is, this was something that I knew I wanted to potentially put into my trading. And again, I'm a very patient person. I review every 3 months. I make decisions every 6 months. I make real decisions every year. So around this time, I decided that I was going to invest the entire year into seeing if this volume profile tool was beneficial or waste of time. Sounds like a cool game show, right? Trading indicator, beneficial or waste of time. Insert game show music, right? I don't know why I did the Trump dance there. But anyway, so what I did was, throughout the year, I did my normal analysis, because it wasn't a new strategy or anything like that. It was just something that I wanted to add to my current strategies to make it a little bit better. So during the year, as I did my normal analysis and did everything as I normally would, I would add this on as part of my routine. So I would put it on my charts. Live remembers, right? You guys remember seeing it on your charts. We would discuss it, and we would see what type of difference it made in the analysis. Now, although it was actively on my charts, and this could be the hard part for many, because it's like a kid on Christmas, or a kid that gets a toy on January 1st, and it's this new shiny toy, and you're like, you can't play with it until next January 1st. So it's really tempting. But although it was on my chart, I wasn't actually able to use it in my trading decision making. So it was information that I had to take in but not use, which is very difficult. But again, I'm a 20-year vet, and what I'm doing has been consistently profitable for a really long time. So I'm never in any rush to kind of implement anything else that could potentially destroy it until I'm 100% sure that it's helpful. The point is, I would track it, and then I had a separate spreadsheet where I would have my normal data tracking spreadsheet where I would track all my trades the way I normally would. Then I had a separate spreadsheet, or separate tab on that spreadsheet, I would say, where I tracked what that trade would look like if I used the volume profile and made adjustments to entry, stops, or targets, right? So throughout the entire year, and you had added a little bit more work, but throughout the entire year, I was actively tracking that tool's performance. Therefore, when it came to the end of the year, it made my job very easy. Remember that A/B split test I talked about? Yeah, that's all I had to do. I put my normal trading spreadsheet up on one screen. I put the volume profile spreadsheet up on another screen. I looked at them very closely, and I determined if this was valuable, or I determined if this helped or hurt my trading, and it ended up getting the thumbs up, which meant it helped it. So boom, it made its way in. With that being said, I'm gonna wrap things up. I know I took up a lot of your time, but hopefully this helps you finish the year strong and really start the next year even stronger. As always, keep working hard, keep journaling, keep trading, keep testing, keep treating your trading like the business that it deserves to be. I'll catch you guys next episode. And until then, plan your trade, trade your plan. Happy New Year!